Hi guys, welcome back to another video. Today we're going to be talking about when the market bottoms. As usual, I have Andrew here with me.
Okay, let's look at what has happened and what is happening currently in this economic environment. And also, we're going to look at this historic data to help us make sense of all of it. Okay, if you go and look at this inflation chart, okay, inflation chart is 40 years high despite retracing back from 9.1 to 7.7. Okay, this 7.7 inflation rate only came about after two bouts of aggressive interest rate hikes of 75 basis points. Okay, before it falls to 7.7 inflation, it had remained stubbornly above 8%. Okay, so right now the inflation is 7.7. Therefore, the probability that the Feds would increase the rates by 75 basis points has reduced significantly. Okay. In fact, they have stated on the 23rd of November, it is time to lower interest rates moving forward. Okay. That being said, right? Okay. That being said, it does not mean that we are going into a low interest rate environment. Interest rates are still going up higher, just that the probability of this of interest rate rising is, the probability of it rising 75 basis points have reduced.
okay.
So if you ask me, okay, now the market is expecting a 50 basis points increase, okay, but however, if for some reason the Fed say, hey, 25 basis point, you can expect the market to rally in a big way, lah.
Right. Because
Okay.
25 is far below what is. But I don't presume we get for 25 lah. Interest rate, inflation is still very high lah. It's not going to be 25 lah. So even if there is a rally, it's going to be a very small bear market rally at this point. It's just a Santa Claus rally. And after that, we're still resuming our downtrend, possibly.
A small rally, I think, if it's a basis point, because that's in line with market expectations.
Right.
But if it's a 25 basis that's unexpected, then it's going to come out as very good news, and then it will rally the market.
But based
Okay.
on his minutes, he's still on the side of caution lah. Inflation is still there lah. So I'm still expecting
Yes,
to see lah. Yeah lah. Okay.
Yes, it's still there. Okay, so there are four reasons why I say that, okay, that the market will have a bad market rally before it actually fall back down again. Is because I think it has not found its true bottom because of macroeconomic situation or circumstances right now. Okay, the yield curve has inverted. Okay, and the labor market is also still relatively tight, and they are still actually asking for the Feds are actually reducing liquidity. For the market to go up, hit higher, liquidity have to be there must be increased liquidity. Okay, but right now the Feds are actually buying back bonds, reducing liquidity in the market, so they will add some pressure towards an upward movement. And then, of course, James Bullard has also mentioned that they might increase rates up to 7%, which is a 3% increment, or is this a cumulative of 3%? That means we are at 4% right now. So if they're going to increase all the way to the end of 3, there's 3%. That means they have to increase by 0.5 basis point for 6 times next year. So there's a lot of rate hikes coming, which means they will be putting some pressure on the markets for the coming year. So I think it has not found the true bottom. Okay.
Do you think interest rate has to be similar to inflation? Like, let's say if inflation is at this arbitrary number of 7%, does interest rate also have to be about 7% to effectively fight it? Since it's
No,
because it's not
it doesn't
direct. The inverse tie is not direct, right? There's other factors involved, right? So
yeah, there are other
it's
factors.
arbitrary lah.
Yeah. So in this market, we actually have two important metrics to look at because the Feds have said many times that they are looking for jobs and inflation data. So they are the two most important, most watched data right now in this market condition. Okay. So if you're going to look into this, then we will look at the yield curve, which is regarded as one of the best predictor of pending recession. Okay. And to let you know its track record, okay, it has successfully predicted the last 10 recessions, okay? But it does not mean a recession will definitely happen, Okay, it doesn't. This is just an indicator, a warning sign. It doesn't forecast the future. Okay, it really depends on other economic factors as well. Okay, why does the yield curve inversion shows such an important metric whether a recession is coming up? We have to first explore and understand how yield changes. Okay.
Yeah, I think you got to explain this for retail investors, like yield, bond prices, and market credit crunch, right? Yeah. So.
Okay, so we have to so we're exploring how yield curve changed. Okay, typically investors receive higher yield for longer dated bonds and lower yields for shorter dated bonds. Okay, but however, in this situation, the shorter dated bonds are giving higher yields than longer dated bonds. This is not normal.
Right.
Okay. Why this phenomenon happens is because, right? Okay,
people expect long-term, right?
Yeah, longer term bonds are considered safe investments, where long term investors tend to buy more of these longer dated bonds and sell off short dated bonds. Okay, and if the market is bad enough, it will reach the point where the yield curves inverts. I hope I'm clear enough. Okay, what it means that the higher the price of a bond is, the yield actually decreases because you have to pay a higher price. More capital is paid for a particular yield. So if the price of the bond rises, yield drops. But if I sell off something, the price of the bond actually drops, and thereby yield increases.
Right? Yeah.
Yeah. So if you see this, how this works, when it goes against the norm, it is a clear indication of market sentiments that long-term investors are a little bit worried about the future, and therefore they sell short-dated bonds to buy long-dated bonds. And this is why the yield curve inversion has happened. Okay, if you look at the chart right now, I'm showing the 10-year versus the treasury yields. Okay, now it has shown that right now we are furthest down below over the last 40 years. 30 years, sorry, in this case, in this chart. Okay. It's usually a warning sign. And if you can see the next chart, okay, the next chart that we have is that it typically shows a recession, that follows after. And this has been accurate over the last 10 recession, and it's typically from this, when the yield curve inverts, we will experience a recession about 19 months from now. That means somewhere in November 2023.
Is when there'll be a full-blown pivot. I mean, a full-blown market bottom, you're saying, so far ahead in advance?
It just means that
based on data.
It just means that based on historical information, I cannot predict when the recession will happen, to be frank with you. But this is based on historical data that when the yield curve inverts, it typically takes about 19 months before we go into a recession.
So all you're saying is that we're not there yet. I mean, current prices of S&P and whatever market is still fairly high. You don't count like crypto, you count like the big players is still very high, right? So if you're saying that means we still have a long way down, if there's still a multiple of interest rate hikes, you're saying that this...
It's not what I'm saying. I'm just showing that there's one metric that is happening right now in the
based
market.
Based on data is 19 months, you're saying.
We have to pay attention to, but it does not mean, because later on I will explain to you why I think we are near the bottom, but we are not really at the bottom. Okay, but it's actually I will explain with further information. You bear with me a little bit. So I'm just explaining to you right now why this recession is it's actually a fabricated investment. It's engineered by the Feds. So we cannot really take too much of these indications as these indicators are as a true blue thing that this is definitely going to happen. Like I said, this yield curve is an indicator. It's not meant to be a forecast. It's just warn us of a pending recession, but it does not mean a recession will happen. So I'm just saying, if this is anything accurate, like you said, like I said, if this yield curve is accurate, then we have to expect a recession sometime before or after November.
But generally, yield curves have never inverted. Like, it's very rare. It's not a normative scenario. Right? Don't you see? Like you look at the previous past data. It's always in like the 2008, 1999, those big ones. Right? And this one is a far bigger yield curve than previous ones. So right?
So they are showing our 100. I mean, there are models out there. There are many different models given by different analysts, different investment banks and everything that shows 100% recession. Okay, but you must understand that right now the recession or the stock market is falling. It's actually engineered because we are in a very unique environment right now where corporate earnings are actually very strong.
So you talk about last video.
Yeah, that's very strong. So this is why I think the yield curve may not necessarily be the best indicator to predict a recession or how much further contraction is going to be. This is my personal opinion. Okay, I'm sure there are a lot of people who disagree with me, but this is just my personal opinion. I think because you see, the other recession is because companies are not doing well. But if you go look at it, the companies are the great companies are still giving good numbers, showing good decent profits. So why is there any reason for the market to fall down? Because actually at the end of the day, it is the earnings that drive the S&P. I mean, that drive the market. It is nothing else. But right now, because we are faced with a high inflationary pressure because of so much QE in the past, they have to remove the market. They have to remove liquidity from the market. So this is why we are doing right now to actually do a QT to remove liquidity from the market. Okay, this puts pressure, but the companies are still making money. So you see, if inflation is the factor and if liquidity is the factor, okay, how will the yield curve? The yield curve may not exactly predict the future market. Okay, that is how I feel. That's how I think as well.
Okay.
All right. Okay, I hope I'm clear on this point. Okay, so having said that, right, there's other factors. The factor also say the Feds are saying they want to look at inflation and jobs data. So right now, our inflation, the jobs data came out at 3.7%. These are not recessionary numbers. Okay, usually a recessionary number is about 5 to 10%. So there's some way to go before it reaches the 5%, before the Feds will say, hey, this is they want to cool the job markets. So before they say that, hey, this is actually a good number, okay, I'm okay to actually stop all of these rate hikes already. Until then, okay, I think the Feds will come to a conclusive thing, say, okay, it's time to pivot. Okay, but right now the job market is still okay. The good news is the most recent that came out about 3 days ago. It has shown some cooling. The job market has shown some cooling, and there's a lot of mass layoff. Like you can see, Twitter, Google, all this mass layoff is going to add to the numbers in the future. More and more layoffs are going to happen. Okay. So this is where I look. If you look at the recessionary numbers for unemployment in the chart that I provide.
Yeah.
The next one. Okay. And you will see that inflationary numbers, you can look up for the last 30 years. Okay, you can see the last 30 years. Whenever we're in inflation, unemployment is above 5%.
Right.
Okay. So we are 3.7. We are some more, some more room to move, before the Feds will be satisfied with the current economic data, and then it will start to have a pivot. Okay. So this is why, right. Okay. So why is this? Why do they have to continue increase interest rates? Because companies struggle when they grow because of the costs. Struggle to grow, because the cost of borrowing are high, and therefore it is harder to justify for risk for increased business activity, and then this will slow down the market because they will not employ any more new staff, and they also reduce debts because interest rate is high. It put a burden on the company, so they will reduce debts. Okay. And therefore, it also reduces activities in other high-cost areas, and then you just to navigate this environment. So this will actually put a strain and create a domino effect, because when unemployment happens, people tend to tighten their belts, and spend less. Okay, this is when
reverse multiplier effect.
Yeah, you are right. Okay, I mean, I try to say in the layman term now. Okay, so I mean, it's true.
It is what?
Okay,
Econs what?
it's reverse multiplier effect. Okay, okay. So what happens here is this is when I think a true recession has happened. Okay, at that point of time, the market will really bottom. Okay. Okay.
I mean, you're saying
So-
that basically inflation ties in line with unemployment, and we had spike up last year, 2020, because of the first fear of contagion with the COVID thing, right? But
Yeah.
over the last couple of months, we have been trickling down. So you're saying that it starts off with, obviously, most market pullback starts with the most overvalued, and we'll say that probably is growth tech stocks, which is why that's all the massive layoffs are coming in, right? That's also why it starts off the whole wave of unemployment. They tighten their own spending. This causes let people spend less. Over time, a lot of people just hire less to make sure that they have positive cash flow. If they are small businesses, they need to cut down costs, right? So in the end, there'll be a whole other wave of layoffs, is why you're presuming that unemployment will increase, right? And then now you're talking about this chart about Fed funds rate against asset prices, in this relation S&P, right? So do you draw this yourself, all these arrows?
Yeah, I draw.
Oh, really?
I draw.
Nice arrows, nice arrows.
Took a lot of time to do this. So please like, share, and subscribe.
Okay, go on, explain the arrows.
Okay. Okay, the arrows. Just give me a minute,
Basically, they are not totally related. It's been related most of the time, but you didn't relate this last time because it's a unique situation as we repeat.
The market don't go in correlation with interest rate hikes, okay? Because the last time you can see whenever they hike interest rates, we see with the blue arrows, okay, the stock market actually goes up. When they reduce interest rate, the stock market actually goes down. But right now they are combating inflation. This is why the inverse is happening. So this is trying to tell you that it is not interest rate hike that caused the markets to come down, okay? In fact, interest rate went up before in the past and it was higher rates than previously than now, but the markets also still went up. Okay. So what I'm trying to say here is inflation is the main cause of this market downturn. So it is my belief that when inflation peaks and comes down, it is when the market will start to recover.
So interest rate is not causation. It's basically inflation is the causation, and then interest rates is just a byproduct of like them trying to combat inflation, right? And basically when asset prices are expensive, they need to cut back everything. So that's where we get our market pullback. So what else can we expand on this?
No, I mean, this is just to show, that, based on past data, a lot of people are saying interest rates go up, the market cannot come
More
down.
like the speed of the interest rate hike also that matters, right?
Yeah, correct.
Right.
Speed of the interest rate, because right now this is happening and this is what they are trying to do. The Feds are trying to force a recession. They're engineering a recession. But the thing here is they are trying to do a soft landing. Okay. But that's not so easy to do. It's like driving in the dark, and then you try to reach your destination within a time frame. And then
Very good.
you don't even know where your destination is, You do not. I mean, this is what they're doing.
Okay.
So if they drive too fast, they're going to hit something and going to damage something. Exactly, that's what they are doing with the hikes, because they do not know when is the terminal rate. What is the terminal rate?
Okay.
They are trying to break the economy, but the thing here is they don't want to break it so badly in such a way that they cannot reverse. So this is why it's extremely difficult to do. So this is why they come out with these rates. They say, okay, 0.75 was 0.5. It was 50 basis point, then increased to 75 basis point. Honestly, they don't really know where it is. It's
There's no
extremely
magic
hard.
number, right? There's just try. You have to figure it out.
Yeah,
There's
and
also
doing
global
that-
market. There's a lot of other things to consider also, right? There's like freaking trade wars and stuff, and global geopolitical tensions.
Having said that, right now they say they won't do a 75 basis point. I think they are doing a tuck and pull. I mean, a push and pull method. They may increase the 75 basis points in the future. I do not know, depending on inflation data. I cannot guess. But let's say if they reduce this 50 basis point right now, increase to 50 basis point, and inflation still keep going up, I wouldn't be surprised they raise to 75 basis points in the future. But I do not think that will happen because it looks like it is peaking, and I believe it is reached its peak. This is my personal belief.
Just because
And-
like the interest rate hike reached its peak doesn't mean it doesn't mean like we have reached the bottom, right? It's not. It's a lagging in the, like it has to take a while more, right? That's what I'm trying to say, right? Sometimes.
Correct.
Yeah.
That is sometimes okay. But I will give my overall summary of my opinion. I still think that we are near the bottom. Okay,
In a timeline basis, but not on a price basis, right? In a timeline, like it's close already, right? A couple more months only, right? Yeah. Most people, I
it's
mean,
hard to-
analysts are saying June, July lah. So there's no 19 months thing lah, right? But we will see when it comes lah. Okay.
Yeah.
This is a bit too lengthy on this part. Let's go to the PE ratio. We're talking about our valuations again.
Okay. Okay. So if we talk about valuation, we go to PE ratio. If you go and look at the historical, you see now we are 21.21. This is based on 15 years data. Okay, we are about one standard deviation from the average mean of the PE ratio for the S&P 500. Okay, and if you were to you move further down the Yardani's research piece.
Yeah.
I mean, I'm going to show you that the PE ratio is based on different years data, okay? And if you were to take that information, you will see that, okay, Yardani is Dr. Yardani. He's a researcher. He does research consulting for global markets, the US economy, etc. like that. You can go to his website, you can go and look and download this information. Okay, I am not that smart to go and calculate and tell you what is the EPS, the forward EPS, but I base on his research and calculate what he has given. Okay, and if everybody who does some investment, and they will say that they will know PE multiplied by year will give you the fair value of a company. Okay, therefore I am actually using this Yardani's research and multiply by the actual data of the PE ratio right now, the average PE ratio of the S&P 500, you see that the market is fair value should be about 4,900. Whether I'm using Yardani's research or using the general consensus market of other analysts. Okay, it shows that we are actually about 900 points undervalued right now. Okay, that means we have a 20-25% upside from this point. So any investors want to come in, okay, any investor want to come in and invest right now, I think it's a good idea.
Will you not say that the PE is a little bit high? I mean, yeah.
Even if I give a 10% discount, okay, 4,400, I still think you are in for a good run, right?
But 21.21 is high. But that's the current one. How do you know PE won't drop? You won't know it.
It could. Okay, it could. But right now, based on data that I'm telling you, it is undervalued. I'm just basing my things on the current data that is presented in front of me, right?
Okay.
So, I mean, anything can happen in a stock market. Anything can happen. I don't have a crystal ball, to tell you exactly what I have. But I'm just based on my experience in navigating the market. These are the tools that I use to determine whether is it a good time to enter the market or not. Okay.
Okay.
Yeah. I mean, if you want, you can go to the online and go and pull out the EPS and multiply based on the standard deviation that was given, on this based on historic records. You can see that sometimes there's overvalue, and it tends to correct itself also. So there's no hard and fast rule to say, hey, that this is I'm definitely correct. No, I'm not 100% correct. What I'm trying to say here that if you were to be an investor, you have to be smart about it and you want to be well informed. So you gather this data, you try to make an educated guess. Yeah, and this is what I'm doing right now. I'm telling you why I think the market is still there's some room to go, whether it's undervalued and anything. Okay, the next area that I want to talk about is earnings. Okay, we know that earnings are, this is hard fact, this is a fact. Earnings are the thing that drive the market. The more money company make, the higher the S&P 500 or the market will go up, the S&P 500 go up. And if you can look at all the earnings, despite it is coming down, okay, you can look at the thing. We are still having more surprises than on the positive side than the negative side. That goes to show that the company's earnings are still resilient against this economic backdrop. Okay, so therefore, I still think that the companies are still doing well, and we can assume that it will continue to do well because especially those bigger companies that drive the S&P 500, okay, like Google, they suffered. They are really down like 30, 40, even 50%. Meta, I think Meta is a great company, honestly, but I think to a certain extent,
Actually, they're lost, right?
they changed their business model to a certain extent that has caused. But if you look at their fundamentals, they are still a very good company to invest because of their
User
sales.
yeah. I mean, they already have what they need to perform, lah. They just have to find their right direction, and then it's fine, lah.
Yeah, they are still earning the same amount of money. So, but why did it drop so much? So I still think
They're not earning
I
the same
still,
amount. Advertisers they drop so much also in terms of they're earning the same because they cut costs. I mean, they're still earning relatively the same because they cut costs. But I'm thinking their revenue is not the same already, right? You want to pull it out?
No, if you can, I mean, you can go and do some research. Their sales in terms of and net operating expenses and everything has remained consistently strong. Okay, which is the key to growth.
Yeah, but actually they're all messed up right now.
Basically they're messed up because they from advertising platform they want to be a metaverse. Okay,
Right.
which is blue. I mean, arguably, I do not know. I mean, honestly, this direction. But you look at the fundamentals. The company, I think, is undervalued. Okay, will it grow to be as strong as last time? I'm not sure. Okay, but it is definitely undervalued.
Okay.
Yeah. This is how I feel, my opinion. Invest at your own risk.
I'll do more research on that.
Okay. Now, if you look at the sentiments, 90%. Okay, this is the part where I say there are more
Positive
surprises
and negative, right? Yeah.
surprises than negative surprises. Okay, you look at the next area where we talk about 90 people believe that inflation has already peaked. Okay. They believe that inflation has peaked. So, like I mentioned earlier, if inflation has peaked, it means the market will slowly move upwards. But because of macroeconomic factors, because of rate hikes and everything, it is not moving as fast as, or the recovery is not going to be as fast as what we're going to be expecting. Okay, next one.
U-shaped recovery, lah. Alright, that's what everyone's saying, right?
Yeah, U-shaped recovery. Okay. Now, wait, let me see. Okay, the fund managers and all are sitting on sidelines and putting the money in cash. Okay, so what does this mean? It means that despite the high inflation, these large investors are putting in cash. So it generally means that investors are waiting on the sidelines to jump right back in the stock market. Okay? If you look into this, they are generally, this firstly uncertain at this point in time, they're waiting to jump back in. So I believe because of all of this, the recovery, when it happens, is going to be fast and furious.
But it's just going to be U-shaped for much longer, I feel, at least a couple of months.
Yeah, it'll be a U-shape. It'll be very choppy 2023, especially in the first half. Okay, until they come to a more thing, it'll be fast and furious. That's what I'm thinking. Okay, other catalyst factor why I think that the market will actually move upwards is also the other catalysts that will support my choppy direction of 2023 is also the midterms election. Oh, sorry, you got this. Correct. The midterms election. If you go and see the midterms election, the market tend to rise after midterm elections. Okay, we currently we are in a split market. Okay, but you can see the information that I provided.
This one, yeah. We're talking about basically it can be Democrat or Republican, but either way, in how many months? 12 months period, we will have a better average return than the general market, right? So
yes, that's right.
Regardless of who is taking seats, it's just going to recover because as long as they have more stable economic environment, it just leads to better recovery. And generally, since midterms is in the middle of the 4 years, we're looking at the 12 months after is probably the third year. So generally, it dips before the midterms, and then there's some stability, and then And this one is also because we did much harder because of overarching circumstances, but generally we should see a run up in the next 12 months based on data. Right, everything's based on data. So that wraps up our video today, talking about when we think the market will bottom. Obviously, this is all speculative in nature, but at least like some data will give us some guidelines on the timeline as well as the price points we're looking at. But generally, I don't believe this to be the bottom. I still think there's some ways to go, but that's my own personal opinion. Do your own research, and as always, remember to like, share, subscribe. I'll see you next time. Bye.